There are a very few defense companies listed in India. The government is giving a lot of importance to allocation in terms of defense, and that's what is generating tailwinds for the sector. It's very critical to understand and choose a company to invest in this sector. It's not so easy because this sector has a lot of dependence in terms of orders and collections on the government, and technology is also very important for the companies working in this sector. Today in this video, we are going to analyze a company called Zen Technologies, which is a small cap company working in the defense sector, and we'll do a complete analysis of the business as well as financials of the company. So if you're new to the channel, please do subscribe and hit the bell icon. And if you have not joined the Telegram channel as yet, please do join as we discuss daily the market views and a lot of exciting stuff on the Telegram channel as well. So let's start the analysis of Zen Technologies. So Zen Technologies is actually not into manufacturing of defense weapons and all. It is into manufacturing of defense training solutions. So what do we call defense training solutions? These are sensors, stimulators, and defense related training sites wherein the soldiers are trained in the environment of that military action. For a country to train their soldiers every time using the real arms and ammunitions may prove to be very expensive. So for training their soldiers, cost effective if we create a simulation environment, and under that environment the soldiers are trained as if it is the actual battlefield. So Zen Technologies is leading in this sector wherein it manufactures equipments as well as installs the sites for defense training systems. So they manufacture various simulators like the shooting simulators, the tank simulators, etc. And recently they have developed a technology which is the anti-drone technology. Now why is anti-drone technology getting more and more important these days is because recently you can see in the Russia-Ukraine war or the other wars also, the countries are using drones to destroy various portions of the opponent's sites. So it is very important for the countries in the world to develop anti-drone systems which can detect and destroy if the drones come into the radar of that country's territory. So this company is doing their own research development of these kind of products and not dependent on any foreign country for use of any technology. So they have 27 years of experience in this field. They have served more than 100 customers and filed more than 100 patents till date. They have an order book presently of more than 400 crores and they have 200 employees working with them. Up till now, they have installed more than 1000 equipments on different sites. Now let's talk about the management of the company. Mr. Kishore Dutt Atluri is the founder president of the company and Mr. Ashok Atluri is the chairman and managing director of the company. Both of these people have an experience of more than 20 years into research and development in the defense sector. And Mr. Kishore Dutt Atluri has a few patents in his name also. Now, how has been the company's journey so far? The company was started in 1993 and in 1998 there were the company's R&D efforts were recognized by the government. In 2002 onwards, they started manufacturing various simulators. They started with advanced weapons simulator in 2002. And in 2004, the company got listed on the Bombay Stock Exchange. In 2006, again they manufactured a new simulator called the BMP missile simulator. In 2009, they started their new manufacturing unit at Maheshwaram. Like this, throughout the journey, they kept innovating and manufacturing new kinds of simulators which could train the Indian soldiers in various defense sites. 2015 was a landmark year in the company's journey where they started manufacturing Zen Combat Training Center. So in this center, what happens? The company creates an entire environment for the soldiers to have a realistic feeling of the battlefield. And in the same year 2015, they got listed in the National Stock Exchange. In 2018, they started their new technology center at Hyderabad, Kondapur. And in 2019, they started a new office in US. 2021 again was a landmark year in the company's journey as they invented the anti-drone technology. And they also started an office in UAE to expand their export business. Now let's understand the company's business. The business can be categorized into three segments. The first one is the sale of equipment. The second is the combat training center. And the third is the AMC contracts. Now let's talk about these things in detail in a simple way. In the sale of equipment segment, the company manufactures various equipments which are used to train different soldiers, and this segment relates to only the sale of the equipment. When we say equipment, the company is the leader in manufacturing defense training solutions in India, and when it comes to the tank simulators, the company has more than 95% market share. In the sale of equipment segment, what happens is the orders come at once in bulk. So there is no uniformity in orders every quarter or every year, but whenever the order comes, they are of generally big size. And this segment involves a strong focus on the R&D. So the company keeps doing the research and development, and they keep developing new products every year. And recently, as you know, because of their research, they have developed the anti-drone technology simulators. The next segment the company gets revenue from is the combat training center. When we say the combat training center, it is the entire setup of a real kind of a battlefield for the client. So in this, the company installs all the simulators which the company has manufactured. So instead of just selling the one-off equipment, they entirely set up the battlefield for the training of the soldiers. In this segment, the revenue can go up to more than $25 million in a single order also. And the company expects these kind of orders to come from foreign countries in the years to come. The third segment which the company gets revenue from is the annual maintenance contract. So whenever they are selling their equipments or they are establishing the combat training centers, the client expects this company to do the maintenance also, because they cannot hire another company to maintain those equipments. So Zen Technologies takes up the AMC of the company. So in this segment, the advantage is they get a continuous revenue every year, and the margins of this segment are also higher. So generally, after equipment is given or the site is established in the combat training center, after 3 years they start the AMC revenue, and as the company's base sale of the equipments increases every year, automatically the AMC contracts also increase, and the revenue in this segment keeps on steadily growing every year. Now let's talk about the defense industry to understand the tailwinds of this industry. The government support is immense in this sector, as the government is focusing a lot on this defense sector allocation. The government wants to promote the companies which are manufacturing the defense equipments in India itself. Gradually, you can hear the different speeches of our Prime Minister and other defense ministers that the government is giving a lot of importance to the drone technologies right from the beginning, and India wants to become one of the leaders in the drone sector across the globe. The government also has levied more than 100 items, embargo on more than 100 items. This will prevent the import of these kind of items from abroad. So the indigenous industries will have that benefit of manufacturing in India. Approximately 52,000 crore of allocation is done for the purchase of equipment in the defense sector in the coming years, and the FDI limit has also increased to 74%. The government has also set up a production target for the defense equipment of almost $25 billion up to 2025, and out of this $5 billion would be for exports by 2025. So the indigenous industries will be supported by purchase of defense equipments from the government, as well as the government wants to promote the export of products for these industries. So that is why this sector is experiencing so much tailwinds from the government as well as the private side. Now, who are the companies which will compete with Zen Technologies? There are some international players like the ECA Group, Rheinmetall, Vitra, Indra and FAC Military. These kind of companies have the technologies which Zen Technology develops, and they are in a way competing with Zen in the international markets. But I am not very sure whether the government will like to work with these kind of international companies for the Indian products, as they have their inclination towards the Indian companies only. Now, what are the competitive strengths or the economic moat of Zen Technologies? They have an experience of more than 25 years in this field, and they have so many more than 100 patents registered already in this field in their name. They have a strong R&D spend, close to 15 to 20% of their sales they spend on R&D every year. This is a IP driven business where the manufacturing cost of the product is not much. The companies get paid because of their intellectual property knowledge which they have in their products, so the margins are very high. This is a very highly regulated business, so it's not easy for a new company to start this business, and the government will also not encourage to buy from any kind of a newcomer. The company's business segment, which is the combat training center, is one of the unique offerings of this company, as they give a real-time experience to the soldiers as a real battlefield. The company will also get an advantage of Make in India movement, because the government will prefer the Indian manufacturers and the imports will not be encouraged. In terms of research and development, the company has spent more than 67 crores in the last 5 years, and out of the total sales, almost 17% is spent on the R&D. There are more than 100 patents already filed by the company. What is the growth strategy of the company going further? The company will focus along with the domestic sales on the export business, and you can see they have started establishing offices in US and UAE already. They want to increase the predictable revenue. So as of now, you can see in their segment related to the sale of equipment and combat training center, they are getting revenue, but in a 1 year they get a huge revenue, and the next year the revenue may again go down. So because of this lumpiness of revenue, the company is not able to steadily maintain the results. So they want to shift their business model, or you can say they want to focus more on the steadiness of the revenue. Now, how will that happen? The existing sale of equipment and AMCs will continue, but they will focus more on the AMC where they are getting steady revenue. So they want to increase the predictability of their revenue. While doing this, what will do, their fixed cost will be met by the AMC revenues, and whenever they are getting huge orders in their sale of equipment and combat training centers, in that that particular quarter or year, there will be huge increase in the bottom line of the company. The company will spend more on the research and development and increase the launch of new products. This will boost the sales of the company as they develop new products. The amount of orders which they get will keep on increasing. One of the products recently which they have developed is the anti-drone simulator, because of which the company feels that as they are one of the first ones who have developed that, the revenue from that product can be higher when compared to the others. So along with the anti-drone technology, they are also working on air defense gun simulators, and they are also developing the logistics drones. So the logistics drones will be capable of lifting a load of about 10 to 20 kgs and delivering up to 10 kilometers. So these kind of drones will be helpful in transporting heavy goods during the military operations, and these drones will also be useful along with the defense sector into other sectors also. The company is also working on in the field of medical care. They have developed some devices in the critical care, remote diagnostics, monitoring, training and medical simulators also. So they are slightly diversifying their business into the medical field as well, and they have recently set up a brand in UAE to expand their export business. In terms of guidance, the company has given a growth guidance of about 300 crores of revenue in FY23 with a profit after tax margin of 40%, which comes to about 90 crore. And for FY24, they have given a guidance of about 400 crores of revenue in one of their interviews on the channel. Looking at the numbers, you can judge the extent of growth the company is expecting in the next couple of years compared to the turnover in FY22. Along with the business opportunities, let us also discuss the risks which this company faces. The company is facing shortage of equipments which they use in the manufacture, that due to which their orders are getting delayed. They are also facing the heat of inflation. Execution of orders will be a big challenge for this company, as in the past you have seen that the company has often had strong order books, but the order execution has delayed, which does not materialize into continuous revenue in all the years. This business is dependent on the government a lot for getting orders which have a lot of screening and tendering procedures, as well as for getting payments as well, although the management says that they get the money from the central government in about 45 to 60 days regularly. A lot of times what happens that the government asks for tenders, and for submitting that tenders, the company has to do a lot of research and develop a particular technology. After submitting that, if the company is not the lowest bidder in that tender, automatically they get rejected, and all the time and money and effort spent in developing that technology and applying for that tender gets totally wasted. This is the biggest risk in this business of this company. Then along with this, there is also a risk of competition, as the government chooses only the lowest price bidder along with the technology in this sector. Now, after discussing the business part, let's come to the financials of the company. In terms of revenue, in the last 5 years, there has not been a steady growth in the revenue. There has been inconsistent order book as well as the revenue for the company. As you can see, they have done a turnover of about 150 crores in FY20, which has gone down to almost 70 crores in FY22. The EBITDA has also not been consistently growing. The company made a loss at the EBITDA level in FY18, and they made a profit of about 63 crores in FY20. Now it has come down to again 5 crores. The EBITDA margin has also been very volatile. It has went up to the extent of 42% in FY20, and now it is down to just 6%. Profit after tax has also not been consistent. It has gone to about 60 crores in FY20, which just came down to about 2 crores in FY22. The profit after tax margin has also been uneven, and it's just about 2 to 3% in FY22. So by this you can observe that the performance of the company has not been consistent, and that's why the margins and the profitability is also going up and down. Coming to the balance sheet, the equity is fairly constant at about 8 crores. The reserves have steadily grown as the company has more or less been profitable over a period of time. They have about 275 crores of reserves on the balance sheet. The borrowings of the company are quite less. They have just about 14 crores debt on the balance sheet, and it is almost a net debt free company. The trade payables are fairly less, so this is a good sign. The fixed assets have almost been stagnant. They have about 67 crores of fixed asset on the balance sheet. The inventory levels have also been fairly stagnant. They have about 25 crores of inventory on the balance sheet. The inventory days are very high. So normally, because the company might take a lot of time to develop a particular product, that could be one of the reasons for the inventory days being high. And secondly, after the product is getting ready for the company to go and install and deliver, that could be another challenge. But whatever may be the reason, in a normal scenario, inventory days of close to 700 days is considered very high in any business. Trade receivables are just about 30 crores, which is fairly constant, and the debtor days are somewhere around 165 days. So again, as the management says in the interview, that the collections are done between 45 to 60 days. But here the scenario is different. The average debtor days of the company show as 165 days in FY22. So the cash position is fine, as the debt is almost zero, and the cash on the balance sheet is about 80 crores. Now coming to the cash flows, the operating cash flows have not been positive in all the years. There have been negative operating cash flows in FY19 and FY22 as well. The free cash flows have also been negative in FY19 and 22, and the free cash flows have not been impressive by the company. The order book position as on 31st March 22 comes to about 430 crores, which is very impressive, but it will be critical to see how much of these orders are delivered in FY23 and how much of these orders get converted into revenue and profitability for the company. Out of these 430 crores, about 115 crores come from the AMCs and about 315 crores from the equipment. The stat auditors of the company are Ramaswamy Koteshwar Rao and Company LLP. There are some related party transactions by the company within the family members, although the amounts are not that material. The remuneration to executive directors is about 1.88 crores. Dividend yield is 0.06, so it's a dividend paying company. The return ratios are very less because the profitability is very low for the company in the recent years. So ROE is just about 0.89% and ROC is just 2%. Coming to the shareholding pattern, promoters hold about 60% in the company and there's no pledge. Earlier there was pledge which was later removed. There are no FIIs or DIIs, just about 0.3% is the FII holding. The public holds about 40% in the company. Now looking at the chart, you don't see a strong steady uptrending chart making higher highs and higher lows for the company in the last few years. Whenever the stock is going up, as the company's performance is inconsistent, there is a selling and the stock is falling down as well. So in such kind of charts, it is important to see whether the company is making consistent performance in terms of the fundamentals, and only enter when the valuations are reasonable and the price has not given a recent high momentum rally. So it is not suggestible that you look at the company's growth prospects, its order book and directly jump into and buy the shares. You should wait for some consistent performance by the company. In terms of valuation also, we will not be able to judge the correct valuation right now as the performance has been inconsistent over a period of time. We should wait for a few quarters and see the consistency in performance and see how the financials are shaping up, and then we can work on the factors what we generally do, like market cap to sales or price to earnings, after we see the consistency in performance. Because in just 1 year, if the company delivers good results in FY23 and we buy based on the higher valuation, in the next year if again the order book goes down, then there will be huge selling in the stock. So the correct approach in these kind of companies would be to wait and watch and see the performance of the company over a period of time and then enter gradually with a reasonable valuation. All the rallies which we generally see on the screen are mostly based on the news which comes out during the budget or other order wins. So it will be a wrong approach to go and chase the stock in any of these rallies. Now let's talk about the thesis and antithesis points to summarize our discussion. In terms of thesis points, it's an asset light business. It doesn't require much of investment, but it's a high margin business. The AMC share will go on increasing and the predictability of the revenue will increase. The government has a lot of support for this industry. The company focuses a lot on research and develops new products, and it's an IP based business, so the cost of product in the sale is very less and the margins are huge because of the intellectual property of the company. In terms of antithesis, the order execution has not been consistent. There are a lot of delays done by the company in the past due to various reasons. There is a dependency on the government to get orders as well as payments. There is a lot of competition in this space also from the national and international players. In terms of fundamentals, the fundamentals don't look so strong and the performance over the last 10 years has not been consistent. So keeping all this positive and negative factors into account, you should take the decision of investing in the company. So this is about Zen Technologies. I hope you like the analysis. If you like it, hit the like button and subscribe to the channel. If you want me to make videos on your favorite stocks, please do leave the name of the stock in the comments below, and don't forget to join our Telegram channel. Thank you for watching and have a wonderful day.